and welcome to a fresh episode of Legal Wrangle, where we'll be presenting before you the latest updates from the latest judgments pertaining to the new GST regime. Let's proceed to the details of our first case, which is not directly related to the GST but may have serious implications for the rules relating to matching of input invoice with the output invoice before the input tax credit is allowed. After the Delhi High Court, which recently ruled in the case of Inquest Merchandising India Private Limited on the issue of allowing input tax credit even if the supplier fails to deposit the tax in the government account, the Maharashtra Sales Tax Tribunal has also ruled in favor of the SSC along similar lines.
In this case, the SSC company received some raw materials of cotton from some suppliers. The SSC claimed set-off of input tax credit, but the claim was denied by the revenue on the grounds of invoice mismatch and the fact that the supplier had not paid the tax. The revenue also put the onus on the assessee to prove that the suppliers had paid tax into the government treasury. Besides, out of the 29 suppliers who had supplied raw materials to the SSC company, a few had attempted to get their registrations cancelled.
On its part, the revenue raised demand and imposed penalty. The first appellate authority granted partial relief to the SSC.
On appeal, the tribunal noted that the suppliers were given registrations after due verification by the department, and in some cases even advisory visits were paid to the place of business of the dealers. These dealers are mostly dealing in cotton, and as per the SSC's admission, they come from Madhya Pradesh during the cotton season and do business and go away. They had not filed returns after registration nor paid any taxes.
The facts that the suppliers did not deposit the tax came to be known only at the time of assessment when the match-mismatch reports were generated with respect to the ITC claims. But the revenue officers had paid visits to the business premises of the suppliers and cancelled their registration retrospectively without ascertaining whether the ITC was passed on by these suppliers. Since there is no possibility of any recovery after the effective date of cancellation, the burden is permanently shifted to the purchaser and he is left to his own means to recover the amount from these suppliers, which in present case the SSC had done by filing FIRs against some of the suppliers and recovered almost 25% of the amount.
The tribunal finally ruled that the provisions of section 48 clause 5 provide that the precondition for allowing set-off is that the tax has to be paid into the government treasury. The claim of set-off due to retrospective cancellation cannot be allowed, but the action taken by the revenue can also not be said to be timely so as to be efficacious action for recovery.
The lesson to be learnt by the GST tax administration is that the denial of ITC on the basis of invoice mismatch may trigger a flood of litigation on issues of different hues where the purchasers may suffer even after paying taxes on the supplies received. A different set of solutions may be explored to plug the ITC misuse if that is the objective. Let's move to our second case. The petitioner company is engaged in the business of providing healthcare services and also in supplying taxable goods. The petitioner was registered as a trader under the UP value added tax. With the introduction of the new GST regime, the petitioner was allotted a provisional ID and password for migration to the GSTN, but it was later detected that the GSTN had used one of the company's directors' PAN to generate the ID. The petitioner submitted a fresh copy of its PAN for correction and the same was acknowledged.
However, the petitioner firm's request for a fresh ID and password received no response despite the lapse of considerable period of time. Before the court, the petitioner claimed that despite updating its correct details, it did not receive an ID and password corresponding with its correct PAN. After some follow-up of its registration status, the petitioner found that the GSTN had issued the provisional ID with the correct PAN number. However, the petitioner had not received the password corresponding to the provisional ID till date. With the date for filing returns closing in, the petitioner filed an application before the GSTN seeking a password, but its application was not acted upon. The petitioner claimed that due to such delay and inaction, it was unable to complete the migration process. Consequently, It was also unable to file its returns or pay its taxes or discharge the GST liability.
The High Court then directed the authority concerned to immediately issue a password to the petitioner company for completing the migration process on the GST portal, for uploading its returns and for depositing the due taxes.
This case clearly indicates the poor homework done by the GSTN and its vendor Infosys, where proper communication module was not developed to keep the taxpayers informed about the provisional ID generated. It also tends to indicate why the GST tax collections are so far much lower than what was expected. Let us now proceed to our third case.
The petitioner is an association of road contractors who are involved in carrying out works for the National Highways and Highways departments. The association was formed for the welfare of all the members. In the pre-GST taxation regime, the contractors used to deposit 2% on value for the works executed under the Tamil Nadu value added tax. However, the contractors were primarily aggrieved by the taxes that they were compelled to deposit when the GST came into the effect.
The petitioner stated that under the CGST Act, the central government had notified that 6% of the tax was leviable towards work contract. The petitioners also stated that the state government was further empowered to levy towards contract tax in addition to the works contract tax already imposed by the central government. Therefore, the contractors would be liable to pay 12% of tax towards the works contract. Therefore, the petitioner contended that for the works contract for which the agreements were executed prior to 1st of July 2017, GST could not be imposed and 2% VAT alone was applicable. They also submitted that any amount of GST paid by them over 2% ought to be refunded to them. The petitioners claimed to have made several representations in this regard but received no response.
The High Court held that the petitioners' representations made in this regard merited a reply, and that the appropriate officer to do so would be the Commissioner of Commercial Taxes. The court further noted that the local authority was ideally suited to address the issues raised by the petitioner. Thus, the court gave the Commissioner of Commercial Taxes a period of 4 weeks to consider the representations made by the petitioner and pass appropriate orders. Let us now proceed to our final case.
A press release was issued by the Ministry of Finance dated 6th October 2017, wherein a relief package was announced for exporters by the Goods and Service Tax Council at its 22nd meeting held on 6th of October 2017. The measures announced were that within the next 4 days, that is by October 10, 2017, the held up refund of IGST paid on goods exported outside India in July 2017 would begin to be paid. The August backlog would be cleared from 18th of October 2017 and refunds for subsequent months would be handled expeditiously. Other refunds of IGST paid on supplies to SEZs and of input taxes on exports under bond or letter of undertaking would be processed from 18th of October 2017 onwards. For this, the Council agreed to suitably empower central and state GST officers so that exporters would get refunds from one authority only.
The other relief measure was that to prevent cash blockage of exporters due to upfront payment of GST on inputs, etc., the Council had approved 2 proposals, one for immediate relief and the other for providing long-term support to exporters. Immediate relief was being given by extending the advance authorization or export promotion capital goods or 100% EOU schemes to sourcing inputs, etc., from abroad as well as domestic suppliers. Holders of AA or EPCG and EOUS would be treated as deemed exports under Section 147 of CGST or SGST Act and refund of tax paid on such supplies given to the supplier. However, the petitioner company challenged such relief measures before the High Court, claiming that despite the supposed benefits from such measures, the situation on the field was very much same as before. The petitioner claimed that it was not permitted to clear the goods, that is gold bars, without payment of IGST of about Rs 58 lakhs. It was also claimed that its protests to the authorities got no response.
The High Court held that, in view of the press release announcing the two relief measures, no distinction was made as between the advance authorizations issued prior to and after 1st of July 2017. Thus, the court granted interim relief by holding that the petitioner would hereafter not be required to pay IGST on gold bars imported by it, in terms of the advance authorizations issued. The petitioner was directed to submit to the authorities concerned a letter of undertaking to the effect that the clearance of the imported goods in terms of the advance authorizations would be subject to the final result of the present petition.
Thank you for watching this episode of Legal Wrangle on GST. Please stay tuned to TIOL Tube for more videos on subjects pertaining to direct and indirect taxation, corporate law and international law. Please feel free to share your feedback with us at editor@tiol.in. Thank you and have a nice day.